Joining us now is the company's CEO, Anthony Noto. Anthony, it's great to have you. Your adjusted EBITDA, $77 million, you had 16% margins, 10 full points above a year ago. And I'm just curious what you did and what you're continuing to do to see that kind of margin improvement.
Well, first, David, thank you for having me. The biggest thing is that when we started to architect a business over 5 years ago in 2018 when I joined, we really focused on making sure we had the right unit economics by product. We have forward lending products, we have checking and savings, we have invest product, a credit card product. And each one of those we've sort of architected so they'll have very high variable profit. We're just getting to the point now where our financial services segment is starting to be profitable. So the lending business on a contribution profit basis has been very profitable. The technology business also pretty profitable, but we've made a big investment in the last 5 years in building out the number of checking savings accounts and acquiring them, as well as credit card and invest. And we're now to the point where we're covering all of that acquisition cost. We only lost about $4 million of contribution losses in that segment, which improved to $20 million versus Q1. And in Q4, it was negative $44 million. So what we're starting to see is the scale of that variable profit exceed the acquisition cost, which is now dropping to the bottom line. So great leverage in the business. Our incremental margins were over 40% on an EBITDA basis and over 30% on a GAAP net income basis.
Right. Well, you mentioned, okay, that operating leverage and certainly the promise of it seems to be helping shareholders feel very confident about buying the stock. Something else? I mean, you added a lot of deposits. Now, you're paying a good amount for them, over 4.2, 4.3%, but $2.7 billion sequentially. How important is that for you in terms of fueling, your ability on the other side of the balance sheet?
It's a critical point in driving both growth and profitability. So those deposits are actually a lower cost of funding for us than using warehouse lines. And we've had the bank for about a year and a half. We've added more than $2 billion of deposits sequentially each quarter, 2.7, as you mentioned, this quarter. The interest we're providing is 4.4% APY on savings if you do direct deposit. But that's actually a lower cost than what we'd be paying the big banks and warehouse lines. So it's a lower cost of funding and a more stable type of funding. 90% of our nearly $13 billion of deposits is from direct deposit customers. We want to have that primary relationship. So we benefit in two ways. One, we have the spending that they do in that checking savings account, but their deposits help fuel the growth of our lending business. And we're one of the few banks that not only provide a high APY in deposits, but we then use those deposits to drive even better returns through our loans, which have high yield, much higher than a 4.4%.
Anthony, we're showing the stock chart, and the stock has had a monster run this year, up 150% almost. Even just since mid-May, the stock is up about 75%, and a lot of that is on the move by Congress to say, folks with student loans, you got to start paying in the fall, and then also the Supreme Court knocking down President Biden's debt forgiveness plan. Some analysts on the street, though, are worried about that notion that there is a big opportunity around student loan refinancing, that is perhaps smaller than what investors think there should be. And so I'm wondering if you could walk us through what you're seeing so far and if you can address that concern.
Yeah, the interesting thing that I'd point out in this quarter is that we had our 9th quarter of record revenue. And that was driven by record revenue in our technology platform revenue, i.e. not lending, and our financial services business, which also had a record quarter. So it was the first time in our history that in our 9th quarter, that record was driven by these two non-lending businesses doing so well. Our lending business has continued to do well also, but the diversification is what's being recognized. As it relates to student loans, there's 40 million Americans that still have federal student loans that they haven't refinanced. SoFi, in our history, has not financed more than 1 million people on their federal student loans. So there's still 39 million people out there for us to help lower their cost of paying back their student loans. But that's on the come. That wasn't in this quarter. This quarter, our student loan business was still relatively depressed. We don't expect to see a meaningful pickup until the end of the year and going into 2024. But the larger thing I'd focus everyone on is that there's 40 million people that still have expensive federal student loans, and we can help them lower their cost on an interest rate basis or on a monthly basis by extending the term.